Good day, ladies and gentlemen, and welcome to the Spark Power Corporation investor call and webcast. At this time, all participants have been placed on a listen-only mode, and the floor will be open for questions and comments after the presentation. It is now my pleasure to turn the floor over to your host, Richard Perry, CFO. Sir, the floor is yours.
Good morning, and thank you for joining us today. Welcome to our 2022 second quarter conference call. I am joined today by Richard Jackson, Spark Power's President and CEO, and Tom Duncan, Chief Operating Officer. Today's call will highlight the company's second quarter performance. Rich Jackson will begin today with remarks on second quarter business highlights, followed by my financial review of the previous quarter, and ending with a brief Q&A session. Before handing things off to Rich, I remind you that our presentation contains certain forward-looking statements that are based on current expectations and are subject to several uncertainties and risks, and actual results may differ materially. Further information identifying risks, uncertainties, and assumptions, and additional information on certain non-IFRS measures referred to in this call can be found in disclosure documents filed by the company with the securities regulator authorities and available on sedar.com. Further, these forward-looking statements are made as of the date of this call, Friday, August 12, 2022, and except as expressly required by applicable law, Spark Power assumes no obligation to publicly update or revise any forward-looking statement, whether a result of new information, future events, or otherwise. I now invite Rich Jackson, President and CEO of Spark Power, to provide his business updates to everyone on today's call. Thank you.
Thank you, Richard. Good morning, and thank you for attending Spark Power's 2022 second quarter earnings conference call. To start off, I would like to extend my appreciation to our stakeholders for continuing confidence in our team. We have been navigating through challenging headwinds for some time, but I'm quite pleased to say that we're on the right track. Our second quarter was an encouraging one. We achieved record high revenue growth and grew the business with several new customers. We strengthened our partnership with Alberta's largest electricity transmission provider and saw positive business results based on our performance improvement measurements. In Q2, we saw solid revenue and improving gross margin performance in our technical services segment, reflecting strong demand in both the Canadian and U.S. markets, and impacts of the hard work and focus on margin improvements in Spark's operating units. Through the execution of our comprehensive performance improvement program, we managed to increase profitability through initiatives designed to expand margins and optimize our SG&A. One such initiative included the consolidation and closure of underperforming branches based on market density and profitability. To date, 6 branch locations have been closed or absorbed by other Spark branches, and further markets remain under review. Related to these initiatives and being rooted in the realities of our current environment, management has taken steps to reduce the size of the footprint and therefore related costs of Spark's new head office facility in Oakville, Ontario. We've also closed out the final founder transition, which is a part of our SG&A reduction and cost initiative. Other Q2 Spark Power business highlights include the launch of liquidity improvement measures in Q2 that also includes the potential sale of non-core underutilized assets in Q3. This includes the potential for optimizing some of our larger fleet assets, reduction of excess inventories, and the sale of underutilized tools and equipment as part of our integration effort. While it's promising to see our upward momentum continue to grow from Q1 into Q2, there's still some heavy lifting to do for us to get to where we believe we should be moving forward. While we continue to work hard on our overall integration effort and put Spark in a position to grow in a growing market, we are also cognizant that there are significant macro-level trends to contend with. We continue to focus on integration and are well on our way to the One Spark operating model, which will help deliver business stability, scalability, and profitability for the long term. This integration of acquired companies and streamlining of business processes, org structure, and the underlying technology will allow Spark to deliver on our operational strategy and deliver premium solutions for our customers. We began making these changes in 2021 and expect to have our integration integrated organization fully in place by early 2023. It is rewarding to see the progress that we are making, and I would like to acknowledge the tireless efforts of our employees over the past 6 months. Our employees across North America continue to contribute to our progress and our success. And once again, thank you to the investment community for your confidence in Spark Power. I look forward to what's ahead for the second half of the year. I'll now turn the call back over to Spark CFO Richard Perry to share our Q2 financial results. Richard.
Thank you, Rich. Q2 was another positive step to reestablishing a consistent earnings pattern in our business and demonstrating our ability to execute our plans to deliver long-term value creation for all stakeholders. I am happy to report year-over-year adjusted Ebitda growth for the quarter of 16.9%, excluding the impact of unrealized gains on derivatives. As expected, we also posted strong sequential growth quarter-on-quarter for both revenues and adjusted Ebitda margins as we continue to execute on our plans to improve margin realization and right-size our cost base. This is in line with the upper end of the range we provided in the corporate update issued in June. More specifically, I am pleased to see the improvement in profit growth across our portfolio, and in particular from our technical services and renewables segments. Demand for the company's key offerings across all markets remains strong, and we are seeing the benefits of the various margin enhancement initiatives lifting gross margins to 27.5% for the quarter, which is up by 380 basis points from prior quarter. In parallel with the focus on gross margins, we are aggressively addressing our cost structure and have executed over $6 million of annualized SG&A reductions through the end of Q2. Overall, we are seeing strong momentum in the business as we enter Q3, and we will continue to drive profitable growth across the portfolio. During the second quarter, we reported record high revenue of $72.9 million as compared to $65.4 million in Q2 2021 and $70 million in Q1 of this year, representing increases of 11.6% and 4.1% respectively. Revenue growth was related to increased demand and volumes in our Canadian technical services business and sustained growth in our renewables and sustainability segments. In our technical services segment, revenues were up $6.4 million as compared to Q2 of last year, representing an increase of 15.4% over the prior year. The growth reflects strong project work in Eastern Canada, consistent with Q1, combined with higher time and material service work in the U.S. Our renewable segment continues to deliver sustained growth, with revenues increasing by $1.7 million or 8% as compared to Q2 of last year, tied to a surge in solar demand in the U.S. market, somewhat offset by softer demand in the overall Canadian market. Lastly, our sustainability segment continues to post consistent revenue results with growth of 12.1% for the 6 months ended June 30th over the same period last year. This reflects the growing demand for environmental attributes in the market. Gross margin, excluding non-cash depreciation and amortization, was 27.5% in Q2 2022, up 380 basis points from Q1, but down 100 basis points the prior year, primarily due to cost inflation. The significant improvement over last quarter is directly tied to the following factors: price actions implemented to counteract costs of inflation, an intentional shift in mix away from larger scale, lower margin projects to more transactional service work, which carries higher margins, and tighter execution of work in the field. While we remain optimistic about our ability to continue to unlock margin expansion opportunities, we are monitoring the macroeconomic and social factors closely and building contingency plans to mitigate any adverse impacts of ongoing rapid inflation, rising interest rates, and/or COVID-19 disruptions. SG&A costs, exclusive of the impact of depreciation and amortization, were $12.9 million, down $0.9 million or 6.5% from Q1 2022. Relative to prior year, SG&A costs as a percent of revenue were down 120 basis points from Q2 2021. Corporate SG&A costs in particular were down by $1 million as compared to Q2 2021, primarily due to lower staffing costs. In the quarter, the company continued to execute targeted cost actions to restructure our field operations and right-size our corporate overhead costs. Through Q2, the company has executed over $6 million of annualized SG&A reductions, which represents approximately 20% of total SG&A headcount. We expect the benefits to be fully realized over the next several quarters. The company recorded a one-time charge of $1.9 million in the quarter related to such restructuring costs. In parallel with the work on cost initiatives, we are on track with our first go live on our new ERP platform for Q3, which will pave the way for further operational efficiencies as we roll out the new systems across the organization over the next 6 to 9 months. The company's reported adjusted Ebitda for Q2 is $10.4 million, or 14.3% of revenue, up from $7.4 million, or 11.4% of revenue from the second quarter of 2021. This includes unrealized gains on derivatives of $2 million in the quarter. Excluding unrealized gains on derivatives, adjusted Ebitda was $8.4 million, or 11.5% of revenue in Q2, as compared to $7.2 million, or 10.9% of revenue in the prior year. The significant increase in unrealized gains on derivatives reflects the early returns on our latest power purchase agreement, which came into effect in the quarter. The gains represent the increase in forward market rates relative to our favorable contract rates in such agreements. During the second quarter, the company increased working capital in support of record revenue levels through the ramp-up of our busy season. As a result, cash flow from operations was a use of $9.1 million in the quarter. Capital expenditures in the quarter were $0.6 million, but we anticipate higher levels of expenditures as we roll out our new ERP platform, as well as complete the leasehold improvements for our new head office. Related to the new head office, we took possession of the space in the quarter and satisfied the requirements of IFRS 16 to record the leased asset and liability, which you will see in the balance sheet. The lease agreement includes a 6-month fixturing period to complete the leasehold improvements, after which rent payments will begin. During the quarter, the company paid $4.1 million of debt repayments to its lender under its term debt facility and principal payments of $2.1 million for vehicle and premises lease liabilities. The net result of cash flows was an increase in bank indebtedness of $14.5 million in the quarter. At the end of the second quarter of 2022, total debt outstanding to our lender increased by $10.8 million to $87.5 million as we utilize our operating line to support working capital needs through our busy season. In closing, I am pleased with the focus and commitment of the organization to deliver a strong quarter on the top line while we shift our focus to enhancing the quality of earnings moving forward. We are seeing the early returns from the important work focused on margin expansion, improving revenue mix, and cost rationalization initiatives. We will continue to execute with urgency and rigor to position the business for long-term profitable growth. I am also encouraged by the level of support from our lender over the last several months and the progress made in our discussions to amend the terms of our existing credit facility to provide more flexibility as we execute the next stage of the company's longer-term growth strategy. We will aggressively pursue all opportunities to strengthen our balance sheet, improve liquidity, and scale our operations for sustained profitable growth. With that, this concludes our prepared remarks. I will now turn the call over to our operator for questions. Thank you.
Ladies and gentlemen, the floor is now open for questions. If you have any questions or comments, please press star one on your phone at this time. We ask that while posing your question, you please pick up your handset if listening on speakerphone to provide optimum sound quality. Please hold while we poll for questions. Your first question for today is coming from Jeff Petherick. Please announce your affiliation, then pose your question.
Good morning. This is Jeff Petherick from Integrated in the U.S. here. Just a question on the the bank indebtedness that bumped up from Q1 to Q2. Is that all related to the credit line and the working with your lenders, and so they increase the availability of liquidity?
Thanks, Jeff, for the question. And so the answer is yes, it all relates to our operating line. And it's important to note, if you step back and look at the end of Q1, we had our rights offering where we raised upwards of $40 million in the capital markets. Part of those proceeds were used to draw down our operating line in addition to settling some outstanding debt. So as of March 31st, our operating line had materially come down. The plan was always to then reinvest that back to support working capital needs through Q2 in our busy season.
Yeah. Okay. All right. That makes sense. And and you paid off some long-term debt in the quarter?
Correct.
Okay. All right. That's all I had. Thanks.
Thanks, Jeff.
Once again, if there are any questions or comments, please press star 1 on your phone at this time. Your next question for today is coming from Paul Teppish. Please announce your affiliation, then pose your question.
Yeah, hi, Paul Teppish from High Rock Capital. Could you give us any financial metrics around the new contract, specifically the Altus one you just announced?
Hi, Paul. Richard Jackson. Sorry, did you say the Ultralink one?
Yeah.
So the Ultralink, just to give you some context, so Ultralink has been a customer for us for several years, and we engage with them on ongoing reoccurring period agreements. So usually they run 3 years with options to run a fourth and a fifth. So we've been doing that since we acquired the Orbis business back in 2018. That business is within the regulated utility segment, and is really focused on substation maintenances and some construction projects. The overriding financial margins on that, we typically run that segment in the low to mid 20 gross margin.
Okay.
With a core group of SG&A to support that in Western Canada. I don't know if that addresses your question.
Yeah, that helps on the margin side. Okay. Maybe work back from there. Okay. Just another question, if I could. 1.9 million in reorg costs across the quarter. Could you kind of split that out a little bit, and maybe specifically, you mentioned something about the 3 original founders and what their role is going forward?
Yeah. Hey, Paul, it's Richard Perry here. So the restructuring costs would be inclusive of all of the actions that are sort of being executed, primarily focused on SG&A headcount, as we have discussed. That would also include the point that Rich made in his comments regarding the final stages of the founder sort of transition from the day-to-day operations of the business. They for sure would be part of the $1.9 million restructuring charge that was taken.
Okay. Thank you very much.
Thanks, Paul.
As a reminder, if you have any questions or comments, please press star 1 on your phone at this time. We do have a follow-up question coming from Jeff. Jeff, your line is live.
Yeah, you guys mentioned on the that there's still some work to be done on the ERP platform, and so you expect some elevated costs in the coming quarters. Is there a dollar amount that you guys are expecting to have to spend there?
Yeah, thanks, Jeff, for the follow-up. So for sure, we have been incurring costs as we have been developing the new system and prepping it for rollout. As we move forward here through the balance of the year into the early part of the new year, there will be some additional costs that will continue to come through. But I would say that we have incurred a fair amount up to this point. Those costs, of course, a lot of them third-party development costs will, have been capitalized and will start to flow through amortization once we start to hit the go-lives, which will be staged, as I mentioned in my comments, starting in Q3 through the balance of this year and into the start of next.
Okay. And it's not a significant capital investment that you need to make there, remainder? I know that ERP can be more of a headache on the implementation side, prior to full launch.
Yeah, so we don't anticipate material additional capital investments there. I think we are well through a lot of the heavy lifting on the development side, and then we'll be into the rollout. Inevitably, there will be some costs, of course, as we are working across the organization in order to have the go-lives and also to support post-go-live. But we don't anticipate any material incremental dollars on the capital side.
Yeah, good. Okay. All right. Thank you.
Welcome.
Ladies and gentlemen, that does conclude today's question and answer session. I would like to turn the floor over to Richard Perry for any closing remarks.
Thank you. As we wrap up here, for sure we would like to thank you for taking the time this morning to join us for our progress update on the business. We are cautiously optimistic that we have the business moving in the right direction, and we are absolutely poised to take full advantage of the market opportunities both in Canada and the U.S. We appreciate the ongoing support, and as Rich mentioned in his opening comments, we absolutely sort of acknowledge and appreciate all the great work that is being done across our business and by every single team member to ensure that we are continuing to take positive steps and really setting up this business for long-term success. I hope you have a great rest of the summer, and we'll be talking soon in the next 90 days. Thank you.
Thank you, ladies and gentlemen. This does conclude today's conference call. You may disconnect your phone lines at this time and have a wonderful day. Thank you for your participation.